am your surprise moderator. I had no idea, but I'm delighted to introduce you to these fine folks who I know for a very long time, and I kid you not, you are really in for some insightful information from true professionals in the microcap space. Rob Wotczak, the president and CEO of Freedom Capital, I've known for 20 some odd years, back in the day when he was a pretty prominent guy at the American Stock Exchange, and goes back a long ways. Same with Paul Dorfman. Paul Dorfman, New York Stock Exchange. I don't want to say the welcome wagon. He's much more than that, but this is the man to know if you are trying to qualify for listing. And always knows the statistics, always is on top of his numbers. And I think you're going to be really impressed with the dialogue you're going to be able to engage in. And Joseph Lucosky, I couldn't be more delighted to be introducing Joe. Joe, who I know probably, I don't know, 15, 20 years back in the day when he was a young attorney. Now look at him. He speaks, I mean, a child attorney. He's still young, but this is a gentleman who has built such a thriving firm. And what I spoke a little bit earlier about, I was actually going to credit Joe Lucosky with his understanding of the power of speaking engagements and really becoming a thought leader. And this man's practice, I don't know the numbers, but I will tell you what I saw on LinkedIn yesterday about the deal that you just closed, that you were involved with. I'm just impressed. So anyway, fabulous group. I think this is going to be a Q&A, and I'm going to turn it over to Rob, and I'll just sit here and keep my mouth shut, but enjoy.
Hello?
Yeah, I think it should be.
Is it on? Okay.
Yeah.
Great. Thank you, Andrea. Always a pleasure to see you, as always. A wonderful relationship. Thank you to Mr. Jim Hawk, to Emily, to Kathy, and everyone at NIBA for giving myself, Freedom Capital Markets, and our esteemed panelists of Mr. Dorfman and Mr. Lucosky the stage here to really speak about the state of the capital markets. We're really excited to be here today. You know, when you look at myself and the two gentlemen to the left, you know, we've been immersed in the micro cap space, you know, each of us 20, 30 years in our careers, 75 years plus of experience. I would venture to guess between the three of us on this dais, and Andrea included, want to make four, have been literally involved with over 1,000 listings, up listings, cross listings, SPACs, whatever. Really understand the capital market. So we're really excited to be here with you today. You know, we want to just kind of go over the state of the capital markets a little bit, do some internal Q&A, maybe go through a couple of slides up here. But we really, at the end of the day, want to make this iterative with the panelists and the audience. We really want you guys to ask questions. We're here as a resource for you to help you in any way that we can with our collective experiences on this stage and dais. So thank you for being here. I'll let Paul and Joe then introduce themselves a little bit as well. I know that most of you probably know them in this audience, and frankly, their thought leadership in the microcap space is self-evident. But again, I'll let them each speak to themselves, and then we'll jump into a couple of topics up here. And then again, please, from the audience perspective, make this as iterative and ask as many questions as you want. I think we'll make the most out of it by making this panel conducted that way. So thanks for being here.
Thank you. Here comes some thought leadership. My name's Paul Dorfman. No, Paul Dorfman, I'm the head of listings for NYSE American. Been doing it a good amount of time. What do they say, in NYSE American years? It's a lot of years. Microcap space years, it's a lot of years. So anyway, that's my job to to help market the NYSE American platform, but also really more importantly is to sort of educate as best I can. And most of the people I talk to are really smart people, whether they're bankers, lawyers, accountants, and executives, but it's to help guide them, you know, A, the value proposition of being a public company, B, value proposition of being an NYSE American listed company, but then also talk about some of the things that, you know, maybe they don't think about when they're in that process of going public, like what happens after you're listed, because that's really more important, right? anyone can get married, it's staying married, right? That's always the thing, to paraphrase Jerry Seinfeld. So anyway, happy to be here. It's going to be a lot of fun, I think, and pass it over to Joe.
Thank you, Paul. Good evening, everyone. My name is Joseph Lucosky. I'm the managing partner of Lucosky Brookman. Before I just tell you a little bit about the firm, I just want to thank Jim for the invitation being here, and certainly for Rob and Paul and Andrea for inviting me on this panel. I also want to say what a great treat to listen to the prior panel and all the wisdom and knowledge and acknowledgement from Andrea and Seth and others. And I know Lisa had a little bit part there. So thank you for your continued leadership, Andrea and Seth and Jim, and I really appreciate being here. So again, my name is Joseph Lucosky. I'm the managing partner of Lucosky Brookman, and we are a law firm that is headquartered in the Northeast with lawyers pretty much throughout the country, but mainly in Florida, California, Texas, Washington, D.C., and the Northeast. And we are super hyper-focused in this emerging growth space, the microcap space, and really anything that is adjacent to those markets. And I'm really excited to speak here today on the state of the capital markets, again, as it is related to the microcap atmosphere. So thank you, and look forward to a wonderful panel.
Great, thanks, Joe. Look, I think we've all seen, the challenges that have been in the small micro-cap space from a capital raising perspective, and I think we're really up here, and I think what we're really starting to see and starting to sense in our respective practices, business, myself as, 15 plus years in stock exchange world as an executive and a few years as an advisor bringing companies public, and as well as now in the last 4 years being the president and CEO of Freedom Capital Markets. I think what we're really starting to see in the last few months and is really a paradigm change, and I think we're starting to see some sectional and sector rotation out of some of the larger names, and not to go through a full deck here, but I think what we're really seeing is that in the last 60 days there's been a true seismic shift out of some of the larger names. The Magnificent Seven names have obviously been hit very hard, and a lot of that money is rotating into the Russell 2000 names. So I think that really bodes very well for us moving forward. I think anecdotally, this is not a talk about SPACs in any way, shape, or form, but what we're seeing also is a reemergence of a lot of SPACs. A lot of them have printed in the last few weeks. Many more have filed. So I think we're well poised and we're well positioned. I think the timing of us being here, the timing of this discussion is really relevant, because I think, with the election, coming behind us here and some of the other, geopolitical situations that are around us, I think our sector, and just to echo Joe's point, we are all in and all passionate about everything microcap and everything that we do in our daily basis of working with companies. So I think the markets anecdotally, and I'll turn to Paul and Joe if they want to comment on this as well, what we're really seeing is some interesting shift here, and I think that again bodes really well for us moving forward into the end of 24 and certainly into 25. So
yeah. So when we were both at the New York Stock Exchange, Rob and I, Rob will often reference that I worked for him. So directionally correct, and I guess I did, but I just didn't do anything he asked me to do. So technically, I guess I did, but I usually wouldn't take his suggestions. Anyhow, I'm kidding. So yeah, I agree. Maybe we don't go from the Magnificent Seven to a $50 million market cap listing, right? But certainly that direction, right? Whereby, the market, maybe, you suck all the air out of the room, whatever you want to talk about, all the money that goes to these mega cap stocks, even beyond that. So perhaps there's some interest in diversity, right? More emerging companies, smaller public companies, higher risk, higher return, the saying goes, and we're all for that. So even if there's less time on CNBC devoted to those companies, NVIDIA and et al., that we all know about, that's directionally a good thing. That let's say how we, let's find some airtime for the Russell 2K right? Let's find some airtime even for the Russell Microcap Index. It's a really neat index, which really kind of, I think, also pretty closely tracks this microcap space. And, you know, I'm all for it, right? So let's see how this shakes out, but I'm encouraged the way Rob is.
Yeah, I think, Paul, you meant the LD Micro Index, not the Russell Micro Index, but just the point of it. No, you did it. You should have, though. It's okay. It's okay.
It's okay. Just as part of full disclosure, Freedom also did a year and a half ago acquire LD Micro, so that is part of the Freedom Holdings portfolio. So the index actually is something very interesting to talk about. But I'd love for Joe to maybe jump in and opine here. And you know, beyond that, there's a slide or two behind that. I'd love Joe to maybe go through some of the, you know, just statistics that we see in our space after he maybe opines on the general markets here, because I think there's some really interesting data points that Joe's going to bring forward here that are really relevant and kind of should resonate very well with everyone in this room. So, Joe, feel free.
Yeah, I think I just poking a little bit of fun at Paul here, but it's all good. I think just on the first slide, on the general topic, from my perspective, again, the way I look at this market and the way our team does is not so much the Magnificent Eight or the Russell, but how does that trickle down to the microcap? Because again, we are hyper-focused on the microcap, which is basically a company with a market cap or valuation of 300 million and below. And that's really the emerging growth space. So that is where we are focused. Now, it's not to say we don't do deals in the small cap space or growing companies, but this is our focus. So the way we look at this market is what trickles down and how do you sort of assess that trickle down effect. It's really hard. We track data. At Lucosky Brookman, we're not just lawyers, we have a data desk. We track every single emerging growth microcap deal that occurs on every major exchange. We pull out the data, we analyze it, we pull it apart, we look at structures, warrants, amounts, median offering sizes, banks involved, to really try to understand what is going on. And I'll just say globally before we get into the data, because I know Rob wants to talk a little bit about what has occurred the first year. The last 2 months, there has been a slight uptick. I wouldn't say a massive celebration, but a slight uptick in the emerging growth space. So in July and August, and we're going to break this down in the third or fourth slide, there have been almost as many transactions that have occurred in those 2 months than the first quarter and the second quarter of the year. So it looks like that the markets are trending in the right direction as far as activity, and then we can break down some of the data regarding what those deals are, how they are executed, and where they are coming from, which I think is a very important new trend that we're going to talk about in a second here, which is from overseas.
Great, thank you, Joe. I think from the slide that Joe has up here, I think it'd be a good idea maybe for him to since he's been on the front line here on a lot of these deals himself and his firm, to maybe talk through some of these data points. And again, we don't want this to be a presentation. We're happy to walk through some of these slides. So if there are any questions while we're speaking, feel free to chime in and we'll be happy to answer. But Joe, if you want to go through the slide, it'd be great.
Yeah, sure. So just walking through this slide, I think it's really important to recognize that there have been 38 microcap IPOs this year for a combined raise amount of about $275 million. Now, that by itself isn't incredibly significant. The more significant number on this slide, in my view, is the one to the far right, which is the median offering size. So for all of 2021, most of 2022, and very brief pockets of 2023, the median offering size was a lot more, meaning companies were able to raise additional dollars, really be closer to that $12, $13, $14 million median raise amount. Recently, as everyone knows, just given where the markets have been slightly challenged, that number has come down significantly. For whatever reason, we can debate inflation and interest rates and global political factors, but the reality is the number has come down. And that has caused a shift in the market for these smaller companies, these emerging growth companies, to use a selling stockholder method that typically wasn't around in 21 and 22. And what I mean by that is they've been using their legacy stockholders in the company to piece together the initial qualifications for the exchange. So for example, if a company has to qualify at $15 million in the public float requirement for NASDAQ or New York Stock Exchange, in 2021, when the median capital raise was 15 million, it didn't matter. Legacy shareholders were kind of, just around. In this market, because it's become slightly more challenging and the median offering price is $6, $7, $8 million, those legacy shareholders, your original shareholders, your friends and family, the people that have been around for the longest periods of time, have become a real significant part in the qualification process. So it really takes both of those pieces now, in my view, to get over the finish line. And I'm sure Paul has probably some thoughts on this too, because this is a big thing with the exchanges and the regulators. How do you piece that deal together and what qualifies for that $15 million? But the point to take away from here is deals are happening, dollars are being raised, but the median offering size has been reduced. So the market is telling us at this point in time, less is more.
Right, and Paul, maybe I think jump in, maybe follow up on Joe's, because I think there's, a few different things, from the exchange perspective that maybe you want to bring up here. And then maybe as we move forward, we'll talk into some of the nuances of rules, but just for the purpose of this question, maybe for the education of the audience, difference between IPO, uplisting, and kind of how that works and nuances. And I know, we do have a slide with the listing qualifications up there. This is not meant for us to go through the slide, but I think maybe putting that slide up and just referencing it as Paul's talking through it might make some sense. So Paul, maybe you could just follow up on Joe's comments and talk just a little bit about process and qualifications and between IPO versus uplisting, spins, cross listings, and direct listings, and those types of things.
Cool. Right, so the standards are the same for all, right? However you come to us, for the most part. You could Google NYSE American Listing Standards and you'll get a nice little matrix, right? Shareholders' equity, stock price, market cap, market value, public float, years of operations, things like that. And most of you probably know all of these, certainly the lawyers do. And that's kind of the starting point in a sense. And so what we do is we ask companies through their lawyers and advisors and all this stuff to have those standards met. If you're, let's say, again, I don't want to go down a rabbit hole, but in microcap world you tend to do that a lot, right? Because a lot of the companies are so close to those minimum standards, that you don't get anyone going, yeah, I know, we're fine, right? That you do. My friends, my coworkers who do the New York Stock Exchange IPOs, right? Raising $20 billion, 300 billion market cap, no one has to look at any numbers, right? Boom, goes through. But so on NYSE American, right, we have to go through this stuff.
We look at a lot of numbers, Paul's right.
Yeah, so it's crazy, but it's good. We get to learn about our customers. So talked about market cap, market value, public float, blah, blah, blah. 400 total holders in North America. We added North America recently in terms of the 400. There was always 400 holders, not round lot, but don't come with 399 people with one share, okay? The reasonableness thing. Facts and circumstances is something you'll hear a lot if you're talking to our reg team, and also it depends. I have an auto response from out of the office that says, if this is a listing, and the email comes, my auto thing that says, an email is, can I list? I write back, it depends. It's an auto reply. It's like my out of office. So it depends. So yeah, not to get too far down, but yeah, 15 million market value public float, right? Those are non-insiders, meaning no directors, no officers, no 10% holders, things like that. We also qualitatively look at things like what shares are locked up, right? Again, this is where the facts and circumstances come in. You guys know this. So if you have 15 million or 16 or 18 million market value public float, but all of those shares, right, are locked up by those early investors and shareholders and things like that, we say, well, how will this trade? That's important to us, right? That secondary market, right? We've got the float, but nothing trades. won't be fun for anybody, right? You'd be like, why did we list? It doesn't trade. And we'll say, they're all locked up. So there's the kind of things that you won't see in our listing standards, but it's the kind of thing that we tend to spend a lot of time talking about, all right, that kind of stuff. I'll leave it there at the moment. I know Joe is chomping to correct me on most
Paul said a lot of things there that I was going to start writing notes down. But,
right, jot this down.
But excellent. That's what happens when you put the head of listings and the lawyer on the same panel. Now, I think you said something very interesting there, and this comes up a lot with companies, again, not to get ahead of ourselves, but how the New York Stock Exchange looks at that $15 million public float versus how NASDAQ does. Because I have found traditionally over the years, the NYSE has had a more thoughtful approach. And this is one of those instances, Paul, where it depends helps. Because sometimes there is no it depends, and the answer is no. So maybe you could talk just a little bit about the reasonableness of that float, because that is the biggest challenge for emerging growth companies right now, getting that $15 million float through the combination of a capital raise and the selling shareholders, and what counts and what doesn't count.
Yeah, exactly, right. So we haven't seen, as you point out, a pure, simple $15 million IPO in a while, like 3 million shares at 5, new proceeds, gross proceeds, right? That's kind of what the 15 million market value public float intended. And then, like all good things, it starts to morph, you know, and then there's the creep. Well, how about this? And how about the next thing you know, you're like, wait a second, we just listed a $4 million IPO. How did they get to 15? Well, all these kinds of things, which is fine. It's evolution, it's back and forth, it's what the market is seeking.
Good lawyering.
Good lawyering, exactly. Sometimes it's a bridge too far, and it's like, you know what, call me next quarter, you know, kind of thing, when things, you know, go in a different direction. So, yeah, so this is a basic definition, right? No insiders, all that good stuff. That said, if it's all locked up, we're going to have to, that wouldn't work, so let's talk about it. Can you have some shares unlocked? You know, that kind of stuff. Lawyers know this kind of stuff, and, you know, the bankers know that is not necessarily things that, you know, people are chomping at the bit to do. But we care also about that trading in the market after. And we've seen with a lot of smaller deals, they don't trade great. Right? Some, you know, we've all, who here hasn't seen a chart of company XYZ small cap, and you see, I think it priced at 5, and then you're like, wait a second, and you know, it's like, you know, was that 52, you know, price, and was that 7, and that kind of stuff gets noticed. We were aware of it, the SEC takes note of it, and then so there's this, right, there's this back and forth between, you know, what does the SEC like to see? What do exchanges like to see? What do investors and bankers and executives like to see? So,
I think if the stock goes from 5 to 52, Rob would call that a successful deal.
call it quickly, though, before the second day or third day of trade. No, I'm joking, but you know it when you see it. So yeah, just last thing on 15, we generally like to see the market value, so 15's a number, is 15 big? I don't know, if the market cap is 40, it's a good sized number. If the market cap is 375 million, it's a small number, 15 million in float. We like to see about 10%. Generally, don't write this down, I'll get in big fat trouble if you do and tell anybody, but market value public float, ballparking at least 10% of the market cap, right? Real sort of informal guidance there.
So Paul, you make a good point on the $15 million, because that is the standard. You have to hit 15 million. There's no waivers. There's no like, hey, we came close. You got to hit $15 million. And we've talked about the average or the median offering price being around 6.8 million. Let's call it $7 million. We talked a little bit earlier about legacy shareholders, you know, the friends and family that have been with the company for a long time, contributing with that $7 million offering amount to get to the 15. New York Stock Exchange has recently implemented this new $10 million gross proceeds rule. There seems to be a little bit of a disconnect in what the data is showing that companies can raise on a consistent basis. Again, that $7 million combined with their selling shareholders. So how does the exchange reconcile that data point, or does it not matter? The amount is still 10 million if you're a microcap company trying to list on the exchange.
Good, Paul, I'll lead.
Oh, okay. Yeah, super quick then, Rob, for sure. I drank the Kool-Aid, so you're like, that's not an answer. So anyway, so yeah, exactly, Joe, right. It's 10 million. minimum proceeds, right? No resale counted, and that's for IPOs, not an uplisting with a raise. That we could do less potentially, but it is that 10. Yeah, I mean, I'm not, to be colorful, it's like, raising the interest rate on someone whose loan is in default, right? Like, well, I couldn't pay at 8%, and it's even harder to pay now at 12, right? So smaller deal sizes, and we're, raising the minimum, right? So it's caught a few companies that were in the process, right? That kind of thing. Well, we said we can do 6, and so we're working those out, right? Like anytime there's a shift. But really, anything going forward, for sure, it's 10. It's the goal is to larger deal sizes, on average, certainly directionally, will help things like liquidity, right? More investors, and reduce the kinds of things like early volatility and things of that nature. So bigger deals, on average, trade a little better. So it's a small step, I think.
And just for the audience, I think this topic we should drill down a little bit further, but just look broadly for the executives that are out here. I think there's a tremendous amount of people in this room, lawyers, advisors, consultants. When you're thinking about a listing, there's really 3 legs to the stool, right? There's quantitative, there's qualitative, and there's corporate governance aspects of it. So, from my perspective, having worked, 15-ish years in stock exchange world, 5 years as kind of an advisor helping companies go public, and 4+ years of running Freedom Capital Markets, the investment bank, pretty good perspective of these topics. And I think what, Paul's, dancing around a little bit, and Joe probably wants to talk a little bit more about here, is, the numbers are the numbers. They're black and white, right? That's number. Corporate governance is really just, making sure that they have the appropriate committees in place, and that's not the hardest thing. Where things come into the exchange is where the qualitative aspects come into it, where the regulators at the exchange kind of can be the judge, jury, and executioner with respect to what goes through, what doesn't go through. So I think it's really important to get that appropriate guidance, from the appropriate professionals before taking that step and bringing the application forward to the exchange, whether it's an uplisting, an IPO, a direct listing, or something in conjunction with the financing. And there are definitely different nuances for each of those types of transactions. And again, folks up here, folks in the audience, lovely young lady to my right, all of us, I think, are extremely well versed in providing that guidance. So, Joe, I don't know if you wanted to jump in there.
I'll just say one more thing on this issue. I look at it a little bit differently. I mean, I'm not thrilled that the exchange has put this $10 million minimum. I don't think anyone can be thrilled, because it's, it depends. It's a facts and circumstances test, and you're setting a black and white line in the sand rule. But here's how I look at it. The market is telling us, and has been telling us for quite some time, that the better, more mature companies with stronger balance sheets are the ones or the deals that are getting done. Now, better is relative. Don't freak out and misinterpret that word. But I think the more mature companies that have stronger balance sheets are making it through the gauntlet. And all of this $10 million talk from the New York Stock Exchange just reinforces that the companies that are going to come through on the public side to our microcap community are going to be stronger and better than ever. And that's all that I think, Paul and his colleagues at the New York Stock Exchange are doing to kind of police the markets. So we have a wonderful marketplace to transact without problems from the SEC and the regulators. That's how I look at it. Now, I wish it was less than 10 million, but we're going to go down this path and see how the next 6 months turn out. And again, this isn't a hard rule, right? This is a policy decision, but there is a line in the sand. So just as much as you brought it to 10 million, you can take it away if things are going better in the future.
Great. Maybe Joe, along those lines.
I think he said absolutely, for those of you that couldn't hear him in the back.
Let the record say I did not say that.
Yeah, obviously, Paul.
Depends.
Obviously, we have an NYSE rep on the panel here, but I think, broadly, for the edification of the audience, and I'll let Joe jump in, and Paul, you here as well. And Andrew, if you want to chime in, you can feel free too, by the way. You're up here. feel free.
Yeah, it does depend.
Yes. But I think, both exchanges, frankly, in the last 18 to 24 months have had some shifts, some changes, rules, and different things. So it does absolutely, even for me and my position of bringing companies public from an investment banking perspective, leave an area of confusion sometimes and grayness. So, Joe, I don't know if you want to kind of talk through some of those high-level things maybe that the NASDAQ maybe have done and your experiences in dealing, and the New York as well, that maybe you want to bring to light here. And maybe that might be enlightening for the company execs that are in the audience that are about to potentially embark on, a go public or an uplisting type of transaction.
Sure, thank you. Well, I think, something we haven't talked about yet, and I don't know if we have a slide on this, but we've focused thus far on the IPO market, so the initial listing market. There's a whole other market out there in the microcap world called the uplisting market. And that's basically a company, either domestic uplist, meaning they trade here on a platform like the OTC, or they trade abroad, which would be called a cross list. And in either case, they're listing on a senior exchange, either the NASDAQ or the New York Stock Exchange. That's what we generally refer to as the uplist market. That market has been decimated over the last 12 to 18 months, and it's really been difficult, really because of one significant policy change coming out of NASDAQ, which is this. If you're trading on a platform, whether it's the OTC or a foreign platform, and you want to list on NASDAQ, generally, the bankers prefer, and Rob can speak to this, they want to eliminate trading risk and risk all around the transaction. So you used to be able to do a consolidation, reverse split, restructuring, whatever you want to call it, to make sure that your price that's trading on these inferior platforms, 20 cents, $1, $2, and you need to get to the minimum of $4, you have to do a consolidation somewhere along the line. And generally, the preferred approach from advisors and bankers have been, you want to do a simultaneous reverse split with your day one listing on the exchange. NASDAQ pretty much stopped allowing that for reverse splits that were over a certain percentage, and a lot of these companies had to, it wasn't a 1 for 2 or, something simple, they had to do a deep consolidation. So they imposed a mandatory 5-day or 10-day trading window post-reverse split before you could list on the exchange. And that caused a lot of uncertainty and risk in the marketplace. And we believe, although we don't have, no one's confirmed this, that small shift has made it incredibly difficult to price an uplist. And you can see only 8 deals have occurred, I believe that's this year, this entire year for eight months. 8 uplists, 1 a month. This number used to be in the 30s and 40s back a few years ago. Now, I know, Paul, the New York Stock Exchange does a little bit differently, and here's where the "it depends" actually benefits us, because I don't believe there is a hard and fast rule at the New York Stock Exchange.
Right, no hard and fast rule on that. And of course, back to the depends, facts and circumstances, et cetera, very useful term on our side, causing consternation on the other side of the phone, on the other end of the telephone. But the kind of things the reg team, I feel like a regulator, even though, again, right, we talk about a lot of regulatory things, and they are important, especially to the space. But in terms of that reverse split and pricing and listing and raising, the bigger the offering is relative to the company's market cap, the more likely it is, right, the raise is that reg would be okay with a simultaneous. Doesn't mean they're okay with it. It's not a blanket statement that you can do a simultaneous reverse raise and list definitely on NYSE American. Not the case. We have to reg, I keep saying reg has to look at it and see how that shakes out. There are situations, Joe, sure, where they'll say, you know what, this is a very small raise, make it reverse, let it trade out for a week or so, and then do the raise.
Now, Paul, you're being negative. We said we weren't going to be negative here.
Right, so.
What is the title of this presentation? A positive look forward.
Well, information is positive. Don't you all feel, at least now you know? Aren't you in a better situation than you were nine minutes ago? Right? Give me the news. Come on, just tell me.
If anybody wants to do a simultaneous reverse split and listing on the NYSE, please call me. I'll handle Paul.
Exactly, but in all seriousness, maybe Paul, a note to self and to your powers to be at the lovely NYSE. Like I think Joe's point and the stats there they're pretty staggering, because I think, traditionally the NYSE American and the NASDAQ capital markets, a majority of those listings in a normal year were uplistings, not IPOs, right? Yeah. OTC. So, and it's unfortunate because I think, the companies that are in that precarious position, and maybe some in this audience, where you're trading at pennies, you have to potentially do the risk, run the risk of doing that reverse split, maybe doing the financing, and leaving yourself, in essence, naked on OTC for 5-10 days, where you can have erosion of the stock to put it down to close to where it was before the reverse split, and put yourself in a position not to be able to do the uplisting. So, I think from an advocacy standpoint, from where I sit, and again, I worked in the building for many years, I think from a business perspective, there's tremendous opportunity for some of these OTC companies if they were given the opportunity or the pathway, the clearer pathway, to be able to do the reverse in conjunction with, and I know there is threading the needle here, and professionals like Andre and Joe, and advisors around, no one can control effectiveness of registration statements or exact timing of exchange, and exactly when the financing is going to happen. It does take some really nuanced work to make that happen anyway, but at the end of the day, if we can make that happen, Paul, I think you would win a lot of listings, number one, but I think at the end of the day, I think it would help a lot of these OTC companies that rightfully so, I think are reticent to do a transaction like that because of the inherent risk that they may have doing a transaction and being left on OTC. Joe, I'm sure you have something to say.
The crazy part about this rule, that there cannot be a simultaneous reverse split and a listing, is this. The exchanges, both NASDAQ and New York Stock Exchange, promote that they are the senior exchange in America. They are the pathway to liquidity, which they are, by the way. They are the 800-pound gorillas. They are the gateway to all great things. And then, for this reverse split rule, this rule only, they say, well, we're going to rely on the inferior exchange liquidity to judge whether or not this will work. And that's why we don't want to do a simultaneous reverse split and pricing. So to me, it's a very inconsistent argument. I'm not saying it's a bad one. I recognize we're all trying to protect the markets and do the best job we can. But I never understood that concept where we say, come to the New York Stock Exchange and NASDAQ because we are better at liquidity, yet then we rely on the previous inferior platform's liquidity. Can we reconcile that?
No.
Joe, that is such an incredibly good point. And I don't know what the answer is until that's reconciled, but one thing I think we've all seen over the years with reverse splits is if there's not something independently significant that's happening at the same time, the chances of the stock not being able to hold its own are great. So it could be an acquisition, it could be that financing. Since we can't wait, since we have this 5-10 day period where these companies are at extraordinary risk, I think all we can really encourage our clients to do is delay until they have something substantial that's happening that can be the story. That something is happening, this company is being restructured, something is happening, they're going into a new sector, they've brought on a new division, they've hired some new people, because the likelihood of the stock really, it's like water finding its own level. It's not fair, but it happens.
It's a great point, Andrea. And here's the other thing. You do a reverse split where you generally have a lower price and a lot of shares outstanding. And you consolidate that into a higher price and lesser shares. And if you're on a inferior platform and you're trading, it is not that hard for a legacy shareholder, somebody who has had deal fatigue or company fatigue or business fatigue, to go around and really bring that stock back down on very little volume. The whole thing we're trying to avoid is little volume and get more liquidity by listing on a senior exchange. And yet we're judging these companies for 5 or 10 days on the inferior platform, trading by appointment, non-liquidity. That has never added up well for me, and I think it is important that if the deal is going to qualify on its own merits, we allow simultaneous listings with reverse splits and just qualify the deal altogether without any hard and fast, rules that say you can't.
Yeah.
Okay.
See what you can do.
It goes, there's always two sides to a story, right? There are buyers and sellers, there's longs and shorts and all that stuff. Anyway, no, I didn't mean that like literally, but there are, of course. Some, I will say some of this kind of the mindset of regulators, I don't mean ours necessarily, are, there's been a lot of, I think, more attention on reverse splits, even as listed companies. We have plenty of those, right? So they're on these great exchanges, and they're still getting hammered, right? And I know the other guys have over 400 companies below $1.
The other guys, I can't say their name. So the regulators have gotten more, it's skeptical is too strong a word, right? They kind of see like, do the split. If you meet the standards after a week, we'll do it, right? Like, this is like a chicken and egg, right? In a way. So it's more like, have a business, meet the standards, we'll review you and list you. Versus, sort of a cooperative kind of experience, like we'll give you sort of a quick, sort of approval, and you do a list, and we'll do a little more of that, and we'll work together to make this happen. It sounds good, and that's what I kind of try to do as a non-regulatory guy, but they take a bit more of a bright line. Again, there's a lot of qualitative things that we talked about, depends kind of stuff, but their view is really that, do it, because they see it sometimes, reverse price list, now it's an exchange-listed company, a week later, a few weeks later, the stocks can revert. I just want to say something,
That's
Paul.
why I say give us a call and we'll look at your situation.
I mean, Paul made a
But I
good
hear you.
point. Paul made a really good point when he said, there's 400 plus companies with some sort of bid price. I think it's 211 actually as of July 31st. That's what our data desk is.
He always 2X's anything.
What do you say?
He always 2X's
He always
anything.
2X's everything, yeah.
It's over 400.
It is over 400 in total, I believe, over the last, but whatever amount, it's in the hundreds. We're going to go with Paul's number, it's 400. The point is this, I think that, that statistic gets a little bit of a bad rap. Certainly, the critics of this listing process do make some good points. Not many, but some. And it is fair to say that some of these companies probably during 2021 or the first part of 22 probably shouldn't have listed or listed too early or weren't in the right space and the market was just going to the roof and they listed. There's some of that. But it's not the entire story. We look at where the capital markets have been over the last year or two. Things have been tough, especially with equities. You look at what happened recently to NVIDIA and some of these others, they have come, what they lose, $287 billion of market cap in one day. Now, granted, they're a $1 trillion market cap, it's less noticeable. But I think there's a part of the story that's not being told, where the market itself has been challenged over the last 18 months, 24 months, and that is a major contributing factor to the low stock price of some, not all, some of these companies. So it is not correct, in my view, to say, and not that Paul said this, but others say this, that, there's 400 companies below $1 and they should be kicked off NASDAQ, and there's these petitions circulating around the industry, and there's these people, screaming from the rooftop saying, all these companies are terrible. I think that is a immature analysis, and you have to look deeper, because we don't exist in a vacuum. The world is here, politics, business, the election. A lot of contributing factors. So I would not throw the baby out with the bathwater and say there's 400 bad companies. I don't know if you have a comment on that, but that's my analysis and view of the marketplace.
Great. Jim, Emily, do we have a few more minutes here on the panel? Yes? Great. Yeah, I'd love to, at this point, I know obviously we've had a pretty spirited debate and conversation up here on various topics. Love to now open it up to the audience, and happy to answer any questions. Mr. Feldman.
Great panel, great job, guys. The bigger picture, though, is since the 90s, we have half as many public companies today as we did then. And the projection is that it will go half again in the next 20 years. Regulatory requirements, private equity and venture capital. How do we quell that, and should we?
Who wants that one? I'll jump in there. I mean, just from my perspective, and obviously.
Repeat the question.
Oh, yes. The question was, over the last several years, the number of public companies have halved, and in the next 10 to 20 years, we expect that to happen again statistically. How do we stem that tide? How do we, I think, going back to like the 90s and some of the investment banks that were there in existence, the Hambrecht and Quist and the Montgomery Securities, the DLJs of the world, where there were true venture, merchant banking models where these companies were incubated properly. I think some of that is lost in this market. And frankly, it's, this is not a Freedom commercial here. When we launched our platform a year and a half ago with some of the differentiators and how we're trying to do things, there's actually an article that was written by an independent person, not by us, that compared us to what DLJ was in the 90s and what they're trying to do. So, David, I think to your question, I think there are ways that this arena that we all live in, and you have obviously are a forefather of the microcap space and have well published on many different topics, and so I appreciate the comments here and the question. I think that if we can have that type of model and banking model come back in place, and and then the other thing that kind of has happened as there's been a race to zero with commissions, which means research has kind of gone away for some of these smaller companies as well. I think if we could plant a flag and address the research issue, address how some of the financings are done, address potentially, the distribution models, and there was retail back in the day that supported a lot of these deals, and a lot of that retail is gone. Us personally are in a position where we have a large retail army overseas that helps with that type of distribution. And the aftermarket support has to be better too, frankly, for these companies with respect to corporate access, to investor relations, and those types of things, in my opinion, because there's a tremendous amount of great companies that are out there that are underserved, undercovered in this world, and I think just getting people to focus on them and putting the companies in front of some of these opportunities and differentiated investors. And I think, maybe with this switch away from these Magnificent Seven and larger names, maybe there are ways to put more eyeballs onto these companies, because there are a lot of diamonds, to Seth Farbin's in the room, there are a lot of diamonds in the rough out there, and there's a tremendous amount of them. We see them every day in what we're doing. We want to help them really badly. So I think there's a lot to be done. So anyone else want to jump in, feel free.
I have a little different view. I think, by the way, thank you, David, for the question. I do agree. You are one of the forefathers of our business. And I still remember the first book you wrote back in 2006, 2007. I read it probably 15 times and highlighted it, dog-eared it, underlined it. So thank you. Thank you for the question, and thank you.
I call him more of a godfather.
Anybody that doesn't know David
Godfather.
should be David. That is true. I look at it a little
OG.
bit. I look at it a little bit differently. Like I'm not so sure less public companies is a bad thing. I think a lot of this started, and to the OTC's credit, with improving disclosures, improving transparency, and kicking a lot of those companies that weren't doing what they should have been doing out of the system. That to me is good because it upgrades our community. It helps our ecosystem. It gives us a better name collectively. So again, depends on how you define public company, but I do think that it's not such a bad thing that we have less public companies. We're just going to have better public companies with better disclosure for investors. So I don't know that data. I'm going to go back and look at it, David, because you always have insightful thoughts. I'm going to put our data desk on it, and we're going to see what it comes back with. But that's my view. In this case, you know, less is more or less is better in my view.
Paul?
Yeah, what's evolution? I don't know, right? The total value of public companies is 100 times what it was back in the good old days. It's $60 trillion, and I know that, as Rob calls it, the Magnificent Seven, it's half of that is 7 companies. Probably not a good thing. Definitely not a good thing. Concentration of anything, you know, next thing you got people with torches running around going, you know, storming the castle. But, so tremendous increase in overall, you know, wealth from, you know, surging equity valuations. Right, but we're not talking about that. We're talking about numbers of companies. Entrepreneurship. To me, I'm not an entrepreneur. I've worked at a company for my entire career, but that's not dead. It's probably stronger than ever, right? It's an urge that everybody has. It's the animal spirits, you know, willing to strike out on your own and then one day maybe be in the form of a public company. So that's always been the case, right? I can't see that's human nature, that ever changing. But how do we make the environment more acceptable, right, to these entrepreneurs? And it's interesting, the listing standards, like I say, you know, you need $2 or $3 in a 50 million market. I don't think that's changed. Those numbers haven't changed in probably 30 years. So we don't take away, we didn't index them for inflation. So, you know, the 15 million market value public float is not now 80 million, which maybe that would be, right, if we did an index. But it's a great question. We all love it. At some level, maybe, I think when the microcap investor, like individuals, people who want to, right, explore emerging companies, smaller public companies, and say, I want some upside for this biotech or gold mine or consumer packaged good company. One part of the factor is when those companies go public and succeed, right, with revenue and operating income, EBITDA, GAAP net income, increase to shareholder equity, book value, right? And they succeed as public companies, and the market recognizes it, right, with an appropriate valuation, maybe higher P to E, but a lot of E, and a comparable P ratio. And when you start meeting people at your cocktail parties and say, I bought this small cap thing, it went public, it raised 20 million, 80 million valuation, it's now 475 million market cap, right? Okay, when we have hundreds of those stories over the years, right, and it's a wagging the tail. I don't know what comes first, but maybe there's more demand for that kind of opportunity. Then the entrepreneurs see that and go, you know what? I'd like to have a company worth $500 million one day, and they go and reach out to the bankers and lawyers and advisors and take that path. But I think a lot of the things that we want to see will take real time, because at the end of the day, an investor does not want to buy a stock and see it go down. They want to have a business that will succeed, right? And that will start to bring in, that will start that cycle in a positive way.
Excellent. Thank you, David, for that question. I mean, I think, again, there's been many attempts, like, again, Reg A, right? That's, you know, you wrote that book as well, was intended to maybe be that, and maybe it hasn't, post-Jobs Act. I think in a lot of ways SPACs, you know, I think were maybe intended to be a player to fill that void. That hasn't manifested itself the right way as well, just because of the irrational exuberance in 21 where 675 SPACs went out and none of them could find deals in a bad market. You're starting to see a little reemergence in the SPACs. I think there are ways, if good quality companies are there, I think they'll find a way back into these markets. So thank you. Any other questions out there?
Right here, Rob.
Sir?
I really appreciate this discussion. I think the insights that you're all giving, Trent, and my question question, I mean, there's kind of multiple levels here. But if you think back about the death of retail brokerages, right?
Yep.
And, you know, how everybody's trading as far as retail goes. I'm not talking about like accrediteds or, you know, people that we may know. But when you talk about the actual retail investor, let's go back, like, say, back to the 80s, right? I remember my father getting calls from his brokers at DeWitt or E.F. Hutton and getting to participate in IPOs like Marvel and Apple. And I'm not talking about the inflated levels, but at the IPO. And yes, he might have been an accredited investor, but he's still only putting in 25, 50,000, 100,000 at the fund,
Exactly.
right? Now, and even in the, you step up into the 2000s and everything else, all your little guys getting wiped out. How do you guys see FINRA itself as being part of the problem? Because now we can't, I mean, how do we talk to anybody about anything? And how do we fight against all the meme stocks and things like that in the brokerage? Like, I'll give you one more example real quick. We're testing something right now. You mentioned about merchant banking and stuff. And, you know, we tried to push a merchant banking operation about 15, 20 years ago. And all we got back from people is like, well, I don't want to invest in a credit card processing company. I mean, people don't even understand what it means, even if some of the people in our industry. And so last thing about that is pipes, for example. I mean, I was there when Cornell started, all those guys and everything else. And right now, we're trying something different. I'm actually raising capital successfully with a pipe that has a conversion above where the stock is actually being traded right now. And of course, we get calls from people saying, you need to issue another 10 billion shares and all that kind of stuff. But anyways, I know it's a lot, but
Great.
what do we see FINRA?
So I'll just try to paraphrase.
Hey, hold on, Rob, before you answer, just as a lawyer on this panel, I just want you to know, as a broker-dealer, this is being recorded, so be careful what you say about FINRA.
Thank you. Yeah, no, just to repeat the kind of gist of the question, and again, I agree with the sentiment, and I'd love to answer, but in essence, you know, back in the 80s and 90s, and I was a broker when I first started my life. I ran a brokerage office as well. I understand the importance of retail investors, working the phones, selling IPOs. That doesn't exist in today's market, and I think that's part of the question. And, you know, with the FINRA regulations and, you know, Reg BI and those types of things, it has made it, from a compliance standpoint, let's say more onerous for broker dealers with respect to retail investors. And, you know, we've seen a lot of certainly the bulge brackets and even middle market banks and even some of the smaller boutique investment banks and broker dealers have morphed to, you know, managed money, right, and packaged products and those types of things as opposed to selling individual stocks. And I think that's a big part of this. So, and I think the third part of the question was the pipes market, where maybe in the 90s and 2000s, you know, pipes were relevant all over the place, right? There were pipe conferences all over the place. I know there's one coming back, I believe, in November after many, many years of absence. But the true pipe market has been non-existent, right, in the small micro cap space for the last several years, and also has left a void in some of these financings. And frankly, some of the deals that got done through pipe type transactions wind up invariably being some of these real toxic transactions that cripple some of these companies, and that doesn't do any good for any of us, frankly, whether you're a banker, whether you're, well, maybe the bankers, but exchanges, lawyers. At the end of the day, it hurts the company and hurts the investors that go in alongside of those deals. So, you know, again, for me, where I sit, just, you know, we work, we're Fortuitous. We have a retail army of like 500,000 retail accounts within our broker-dealer attached to it with 1,000 brokers, where it still is, I call it, anyone, I have some colleagues in the audience, I say back to the future. From where I was 25, 30 years ago, it's exactly that way, where brokers still call up and sell stock and get paid a commission to do so. And you know, some of the deals that we've done specifically have been placed largely into this retail army, and the deals that have all been upsized, they've all been traded well at lesser discounts. So I think there are ways to kind of shift the tide here in this market, but there are definitely challenges that go along with it. And Joe, thanks for the heads up on the FINRA thing, but feel free.
Speaking of FINRA, we see FINRA from a different angle as lawyers and deal lawyers and regulatory lawyers. And I know all the lawyers in the audience here know what I mean. It is a painful process dealing with FINRA at times. It is, I can't even describe, and David, he's nodding, and I think he's clapping, but it is true. And I really am hopeful that as sort of an industry, we really have to do something, because when we talk about uplist or even just reverse splits, it is getting harder and harder, because a few years ago, they sort of gave FINRA more authority instead of just being sort of box checkers and saying you have this form, this form, this form, you can do a reverse split. The SEC said, hey, you can, deny or approve things based on the public interest. And it gave FINRA this ability to, start to think for a living. And that, you would think is a good thing. But what it caused is this whole glut of problems where FINRA is now putting their judgment on the markets, on companies, on individual investors who are invested in the company and saying, we don't like this person, so therefore you can't do your corporate action until you buy them out, or you can't do your reverse split until they convert their note. It has been very, very messy. So my hope is that as sort of ambassadors to the industry, all of us, the professionals, we can figure out a way to come together and fix this problem with FINRA, because it is really, really hard to deal with them at times. And again, I say this with genuine respect for FINRA and for the industry. It is just very challenging, and we need to figure out a solution to it so companies can uplist better, split better, change their name easier without having these tremendous delays.
Great. Jim, do we have more time for more questions, or should we wrap it up? Okay, great. Any other questions in the audience?
We can't be that good. There has to be more questions.
Lou has heard enough. He is gone.
Nothing? Okay.
Oh, back there.
There you go.
Thank you for the insight, guys. The question is, with legacy shareholders, for example, when a company goes public, why isn't it that, like, for example, if the stock goes up to 52, sounds great, but if you can't liquidate after 6 months, the stock goes back to the original price or below it, then that legacy shareholder doesn't take advantage of the opportunity of the IPO. Is there ways that the issuer can kind of maybe decide to do a lockout leak-out agreement, like maybe 10% of the first day of trading, assuming he's locked up from going public before that? He's been locked up for 5 years before
Sure.
the public, you see? Yeah. So there's a kind of a...
You want to repeat the question, Joe?
Yeah, so the question was, how do legacy shareholders basically exit their position on a listing? Do they have to wait 6 months? Because usually if the stock rides up, it may come down a little bit or completely after the 6 months, and then you have all these legacy shareholders not taking advantage of some price appreciation. I think there's two thoughts to that question that come to my mind. The first is, sometimes depending on how long you've held the stock, depending on when you've actually invested, you may not be able to sell because of the rules that allow you to, get what we call free trading stock in the industry versus restricted stock. So one way to alleviate that, assuming there's no lockup or leak out or contract that allows you not to sell, is by doing a selling shareholder registration. So in your IPO documents, you can actually register some shareholders. And that's what we talked about before. When the median offering price is $6 or $7 million and we're trying to get to 15, it's those legacy shareholders that make up that difference. So theoretically, they should be able to liquidate or sell on day one if they're registered. Separately, if you have a contract or if you have to sign a leak out or lockup, that gets into what Paul was saying. Do we even count those for the float? And sometimes bankers, when they're doing a primary deal, they don't want to have all these legacy shareholders coming to market with lower valuations, and they want them locked up or leaked out or somehow now restricted, so the people that are coming into the IPO or the new deal have what we call, a good runway. It's probably exactly what Paul here is trying to avoid in his qualifications, but that is sort of the game that is played. So your question is a very good one. How do we balance the legacy shareholder value to participate in the offering and establish true liquidity with the new IPO investors coming in who believe that, their way is the best way?
Andrea?
I mean, it's unwanted competition, and I don't mean anything at all disparaging to the investor groups that are coming in, but they want to be able to exercise their rights and recoup their money and have that opportunity without a lot of competition. So yeah, there does have to be a balance, and maybe we just need to be thinking outside the box with respect to some type of compromise. Maybe it doesn't have to be some complex leak out, but a way for these legacy shareholders to be able to participate, because what it helps, in essence, is the liquidity all around. So it's a benefit. It shouldn't be something that's so frowned upon, because the new investors coming in, without that liquidity, they end up harmed too, right? They end up harmed as well, because the stock can't hold its own. So, we just have to be discussing, thinking, coming up with ways, and I think there is an answer. I think with people like these gentlemen on the panel and those of you that participated, we're talking, we're asking the right questions, and I think good things will come of it.
Guys, you got...
Amen.
Is this working? It's working?
Yeah.
You guys did one heck of a job. Let's thank them, because this is really... Andrea,